Fed decision is in. We got to talk about gold. We got to talk strategy for gold, because on the surface, Fed decision seems like a non-event. Not true. We got some very, very important information that the market is missing right now that we need to talk about, and that sets us up to talk about how do we position ourselves in the gold market specifically, and why that is more important than silver and the other precious metals. Let's talk about it. Welcome to Hot Trades of the Day, your show for swing trading ideas for the coming days, weeks, and month. Okay, housekeeping first. I know I said I'm going to do the second part of the Sky Harbor company analysis today. That's got to wait a day. Maybe till the weekend. The stock's not running away from anybody, so no problem. But we got some important information from the Fed meeting that not enough people are talking about right now. We got to look at gold specifically. We'll talk about that in a second. And we got to talk general strategy for gold. That's something that nobody's talking about as well right now. That's going to be really important. All right, let's start with the Fed meeting. 25 basis points rate cut. Everybody knew that was happening. It was coming. Check. Announcement, 2 more cuts likely in 2025. Check. All right. Everybody saw that coming. This is a non-event. This is where things get interesting. Jerome Powell said that 50 basis points was not widely considered among the Fed governors. That's interesting because Stephen Miron, who is basically Trump's choice to succeed Powell at the end of January next year, was in favor of 50 basis points. He's also in favor, and this is the most important information, of more rate cuts in 2026. Surprise, surprise, if you're a Trump appointee. This is important. Not enough people are talking about this. Why? Because, as I just said, Jerome Powell's term ends on January 31st. That's when Trump very likely gonna appoint Stephen Miron, and then we know we're gonna get more rate cuts, maybe even more aggressive rate cuts. What does that mean? Inflation is rising. If, on the other hand, we look at the economic data, especially the labor market, especially US housing construction, it looks dangerous. And that means all of a sudden, stagflation is on the table, and we need to factor this in. And if this stagflation risk materializes more and more, that explains a lot why gold is running so high in the past weeks and is not even doing a healthy consolidation. Yes, a lot of it, obviously, we know this has to do with trend following models. I've explained this before. It has to do with institutional investors, asset managers, family offices being massively underweight in gold. I've talked about this before, especially in the US. They all need to buy. That's why every small weakness is getting bought. But it always felt like there's something else under the hood brewing, and this could very well be it. So we need to factor in a stagflation scenario for the coming years. Who gonna be the winners in stagflation? Well, we all know who the loser's gonna be, and that's gonna be the labor force. It's also gonna be consumer products, especially on the luxury side, that people can pass on. But who's gonna be the winners? Well, historically, gold has done extremely well in stagflation times as a store of safety, but here's the interesting part. So, if gold does well in stagflation and goes up and we are in a raging bull market for gold. And as you know, my price target for this rally phase that we're in right now, which we'll get to this in a second, might actually take a little longer than anticipated after this run up, but we'll talk about it in a second. Look at this beautiful uptrend channel. I mean, this is as strong a bull market as you can have. So if that's the case, and we know that we have massive buyers of gold with the central banks around the world, especially emerging markets, and underinvested institutional investors, the big winner's going to be the producers, the gold producers, because they're going to be gold producers. That's going to be one of the sectors, think about it, that's going to have high demand for their product, and they're going to have higher prices if the gold price keeps going up. While other companies will have to cut labor force, will probably have to deal with lower margins and lower revenues, the gold producers, and I stress the word producers, will have the exact opposite situation. So that is why we want to use any weakness in the gold producers. I'm okay if you want to get into the developers and the explorers as well, but we're just talking who's going to win in a stagflation scenario. That's going to be the producers. Who's going to win in an inflation scenario? That's going to be the producers, because gold is going to be in high demand because of inflation. So the product that they produce is in demand. So that is why I'm such a fan of the producers, especially the junior producers who are going to increase their production. So we have the double turbo, as you know, of increased production and higher gold prices. So that is the strategy for stagflation. You want to have gold, you want to have gold producers. You want to focus more on gold than on silver or platinum or palladium, because remember, those are hybrids and they have a large industrial usage. Now, silver has their own situation with the short squeeze, as we know, and obviously the gold-silver ratio, which is still at historic very high levels. I mean, it'll never go back down to the historic levels of like the 70s to 80s or whatever, but it's still high. So you would think that at some point silver will catch up, but not sure if the stagflation scenario is really a scenario where that'll happen. We have a specific situation where gold becomes more valuable than silver, because gold is a store of safety, gold is a store of value. It doesn't have any problems with the industrial usage that silver will face, that platinum will face, that palladium will face. Now, another thing that's beneficial for the gold market, have you looked at the diamond prices in the past year? Whew! Man, you look at the chart of diamond prices and they have completely collapsed. Reason being, the fakes are so good now that people are just staying away from buying diamonds. The risk is just too high that you run into fakes. What does that mean? The people that were buying diamonds as a store of value, which was a fantastic store of value for decades, well, that's gone now. Where will they go? Yeah, that's right. They'll go right into the gold market. Okay, so we know this is what we want to do. But now we need to look at gold because we have this run up. So this is the daily chart. But what I really want to show you is a longer time frame. So we are cooling off a little bit, but in overbought levels, as you can see. I drew in these two new uptrends. They're getting steeper and steeper, which is clearly a sign that things are overheating. We already broke the first one, but this is the one, let's take this out. This is the one that we need to watch. So that means we go below 3,620 on the close, then we'll get a bigger correction phase. Until then, doesn't matter, especially if we stay over 3,650 on the close, everything is fine with gold. Now, let me switch to a longer time frame. And let's go to the monthly chart. And boy, oh boy, not many people are looking at the monthlies in general. I understand that, but especially with an asset like gold, which is a long-term investment asset, people should. Look at this RSI. I mean, it is insanely overbought. We're almost at 89, all right? In July 20, when we had the last big gold craze, we were at around 84 in the peak. So we're already higher than this. All right, let me zoom out here. Where are we? Nope, this one is certainly lower. Yep, that's a 79. So now we're already at 2007, where we basically are at an 86. That's still lower than it is today. Okay, here we are at 2006. We are at an RSI of 85. Still lower than we are today. Now we're in the 1990s. Still going, still going. Now we're at the 1980s. Still, oh, here we go. Here we go. December 1979 is basically the time when the RSI hit a 92, a little less, but you get the point. And that was higher than we are today. All right, we are talking, we almost have to go back, what is that, 47 years, almost 50 years to have an RSI as high as we have now. Now, we have a different situation now with the central banks buying, no doubt. But would you bet that the gold price will keep going up at this rate with an RSI that is at the second highest level in 50 years without a correction? I wouldn't. I'm just being realistic here. All right. Let me show you something else. I should have figured this part out earlier. So since we had the breakout here for gold in March 2024 from the old all-time highs, and we started this whole up move, the best indicator when to buy was the 50 weekly. Look at this line. It has been the perfect time to buy every time. Where did we bounce off in July and in August? Here it is. What we also see, very interesting, look at this. We hit it, we break out, we come back to it. We hit it, we break out, we come back to it. We hit it, we break out, and we came back to it this time as well. You think it'll be different this time after the breakout? I don't think so. So what does that mean for us? That means at some point we're going to come back down to this moving average here, which will by then likely be around 3,500 to 3,450. Aligns perfectly with what we've been talking about before, retest of what's also often called the scene of the crime, the breakout area. So this is the downward potential. When are we starting this correction? That is the question that everybody has been asking. I've been showing you in this new uptrend channel that the price target zone for the first part of the rally would be 3,700 to 3,750. We basically hit 3,700 already. We might push up and hit 3,750, which is the upper end of the uptrend channel. Would I be an aggressive buyer of gold mining stocks and gold right now? I would not. I would wait. There is, because of what I just showed you, in the long-term monthly chart, there is a real risk that almost nobody's talking about, that we hit a cycle high, right? If we look at the RSI levels, look here. We are higher than we were here, major correction period. We are higher right now than we were here, correction period. We are higher right now than we were here, sideways correction period. We are way higher than we are here. Massive correction. We're not going to see this. But you get the point. I can go back if you want. Well, this one obviously was a big bummer, right? We basically went into a 20-year correction. Obviously, that's not going to happen. But what I'm saying is the monthly is telling us there's also the potential that we're going to have like a short midterm cycle high, and that we're going to go sideways for several months, which would actually be healthy. So what does that mean strategically? That means we need to factor this possibility in. So we're not selling any gold. I'm certainly not selling any gold. In some of the miners that you are up a lot, maybe you want to take some profits just to be liquid, because if this happens, you get a lot better prices down the road. You don't want to be leveraged in gold. You definitely don't want to be leveraged with options that have short-term expiration dates, because we might get a correction phase that is longer than people think right now. Now, do I mean a year? No. Do I mean 3 months? Possible. It's possible because nobody's talking about it. So factor this into your strategy for gold, both the stagflation scenario, the cycle high. Now, this is not the end of the gold bull market, right? It would just be a consolidation. And as I've shown you, the downside potential is not that much. Might just be, like we saw before, a correction over time. This is not the time to be super aggressive in gold. The time to be super aggressive in gold was what I had pointed out early in hot trades of the day, were the breakout of the sideways trend, right? And if you didn't see the videos, hit the subscribe button so you do not miss these type of videos. We had this breakout and then we had these two breakouts. That was the time to be aggressive. Up here, you want to be cautious. So that's it for today. We'll see us tomorrow. Have a great day. Bye-bye.